Hello and welcome to Gold and Silver Assets. It's Sunday the 17th of May 2020. So one of our viewers recently asked me what my motivation for doing these videos is. And my answer to that is that it helps me to formally gather my thoughts and also to crystallise my thinking. So today I'm going to talk about one such example. Now we know that commodity prices are cyclical and that we're currently at a low in the cycle. And I'm going to show you a chart a little bit later that illustrates how we are in a low. But something that's been puzzling me for a while now is what is it that's going to spur commodity prices into the next upswing? We know that the global economy is struggling right now and industrial demand has certainly plummeted. And even if we do move into a recovery, it's not going to happen overnight, and certainly not particularly rapidly. It's not like turning on a light switch. So originally this video was going to be about interest rates, and while I was preparing it, that's when an idea came to me about the trigger for the next commodities boom. So the story starts with this chart of nominal interest rates, which goes back to 1770. And we can see that we are currently at historic lows in terms of the yield on the 10-year US Treasuries. But this chart doesn't take inflation into account. When inflation is taken into account, that allows us to determine the real interest rate. So that's basically the nominal interest rate minus inflation. And the importance of the real interest rate is that it kind of represents like the purchasing power of investment capital. That's how I think of it. So let's start by looking at some examples. If we start by looking at an environment of inflation, and we'll use 2% inflation rate that the central banks seem to aspire to. So when the nominal interest rates are higher, let's say 6%, then the real rate is plus 4%. So that's 6% minus 2% equals plus 4%. Now, in this situation, the investor would prefer to get these gains rather than buy gold, which basically provides no yield and also has storage costs. However, as interest rates get lower, real interest rates go into negative territory. And that's even more the case if the nominal rate goes negative. So in this case, an investor would prefer to buy real assets right now rather than invest their capital over time, in which case they're effectively losing their investing purchasing power. So in theory, a negative interest rate is good for gold and commodities. But what if we enter a deflationary environment? So we'll use an example of minus 2% rate of inflation, so that's deflation. Remember that if we minus a minus number, that's the same as adding them up. So here we've got the example of a nominal interest rate of 6% minus a inflation rate of minus 2%. So that's effectively 6 plus 2, and that gives us plus 8%. We can see that the nominal interest rates need to go deeper into negative territory to make the real rates go low or negative. Now, nobody knows for sure what's going to happen, but here are my thoughts. Currently, the Federal Reserve are controlling interest rates and they're working very hard to keep them low. If they try and raise the rates, then that's likely to trigger default, since there are many private companies and also sovereign debts where basically they can barely make those interest payments even at these low interest rates. The other thing is that we know that the greatest dread of central banks is deflation, and they're going to pull out all the stops to try and avoid deflation. So overall, I think we're looking at a scenario of low nominal interest rates in combination with inflation, which means persistence of negative real rates. Now, I don't know if that is exactly what's going to happen. Nobody really knows. But that's what I'm postulating. If that is the case, then what does it mean for gold? Well, this chart shows the real interest rates in the blue line compared to the gold price, that's the red line. And we can see that there's a pretty good negative correlation between the two. So in general, as the real rates go down, gold tends to go up. And this has certainly been the case for the last 15 years. But what about on the longest timescales? Well, again, this is generally true, but there are some exceptions. So for example, if we look here between around 2006 to 2009, we can see that we had positive rates, but gold price still rose over that period. So this isn't a hard and fast rule, but in general, we can say that negative rates are good for gold. So currently, the real interest rates in the USA are about minus 0.5%. So how negative can this go? This is a chart that I found really fascinating. It's from a paper from the Bank of England, and I've included the link in the description. And it shows the real interest rates globally from as far back as 1320. And overall, we can see that there is a long-term general decline in the real rates. We can also see that there are two huge spikes here and here in the early 1900s, and they dwarf the spike that we saw in the 1970s over here. The lowest that these rates went were around minus 10. The other fascinating thing I find about this chart is that they've also shown where easing and tightening regimes have occurred. So the green areas represent easing and the pink areas represent tightening. And we can see that over the last 2 centuries, two things have become apparent. So firstly, the easing regimes seem to be getting longer and longer compared to the tightening duration. And secondly, the real rates get increasingly negative during the periods of easing, and then when the easing stops and tightening begins, then that reverses and then the rates go positive again. So right now, to me, there seems to be no end with regards to easing policies. And to me, that suggests that the real interest rates are likely to remain negative, and it also suggests that there is potential to go a lot deeper in the negative territory in terms of real rates. Looking at the real interest rates in Venezuela, we can see that in 2017 they went as low as minus 80. That's huge. So from this we can deduce that deep negative real rates are certainly within the realms of possibility. And this brings me back to the original question regarding commodities. Now, ideally, what I'd really like to do is see a 120-year chart of real interest rates versus inflation-adjusted commodity index, but I haven't been able to find such a chart recently, but I will keep looking. So instead, I'm going to show you this chart, which is the commodity index to the Dow Jones ratio. And we can see that we're at historic lows, and commodities are undervalued compared to the stock market. We can also look back and see these spikes over here and here, and those are the ones that seem to correspond with the negative real interest rates that we saw in the earlier chart. Now, of course, remember I said that this isn't ideal because we're throwing the stock market into the mix, but certainly during the Great Depression, commodities did very well compared to the general stock market. So where do we go from here? Well, my view is that there is going to be a limit to the downside as far as commodities go. Commodities can't go to zero. So that leaves us with either sideways movements, and certainly that sideways movement can last for many years, as we saw in the 1960s here. And the other possibility is that we get a reversal and a spike upwards. And as I mentioned before, I was struggling to work out what it was that would propel commodities to go upwards in the coming years. And now I'm starting to wonder if negative interest rates is the answer. Now, you could say that Japan and other countries have had negative interest rates for a few years now, and it hasn't really had any major effect. But if you look more closely, in many of those cases, the real interest rate has not been particularly negative, and in a lot of those countries, they're actually positive. So actually, I think the important factor here is that those countries aren't the world's major reserve currencies. And remember that commodities are priced in US dollars. And so I suspect that if we do have both negative interest rates and negative nominal rates in the USA, this could well drive investors into the commodities. So that was just something to think about there. Let's move on to the market update. And we'll start with the S&P 500 on the daily scale, and let's have a look and see how our little lemmings are doing. So back in early May, at this time point here, it looked like the lemmings had just about fallen off the cliff there, and then they seemed to be defying gravity and levitating. But as I pointed out, we seem to have another ascending wedge that was forming, and so I said that I was skeptical that this would rise further, and it was unlikely to breach that 3,000 level. Of course, that wedge ended up playing out, and so it broke down from there, and we started to see a drop. But then again, the lemmings seem to be trying to defy gravity again. This is kind of a bit like when you see Wile E. Coyote coming off the cliff, and he hasn't looked down, so he's still staying in midair. So we're still at the point where they haven't looked down, and they're probably just moving their legs backwards and forwards in midair, trying to stay up there. But as I said before, I'm skeptical. I don't think you can defy Mother Nature, and I think the move is down from here. And another thing to support that idea is if we look at the same index but on the 30-minute scale, and those little wedges become more obvious here. So this was the earlier one that we saw in early to mid-May, and just in the last few days we can see that there's another ascending wedge that's forming, and so that's what to me indicates that we've got further downside to come. But yeah, I found that really fascinating. We've got 3 cascading wedges here, just getting smaller and smaller. Moving on to gold in US dollars on the daily scale, and last week we mentioned this ascending triangle that was forming, and we said that a breakout above the 1720 level would indicate further upward movement, and the target for this triangle would be just around the 1800 US dollar level. We certainly seem to be moving in that direction, and so the assumption has to be that we remain in this uptrend. Certainly the top of this channel line has remained supportive, so again that makes us more confident that we're going to continue upwards. What are the possible routes to get there? Well, it could just shoot straight up there. Another possibility is that we dip down to retest that triangle and then move up there. I would start to get concerned if we broke the upper trend line of that triangle. So basically a break below around 1710 would be worrisome. If that did occur, then that would make me think, well, we're not actually looking at a symmetrical triangle here, and instead what we could have is an ascending triangle. So if price fails to go above 1750, that could be something in play, in which case that triangle hasn't played out yet. And the reason that I'm not full on bullish yet is if we go on the longer time scales by looking at gold in US dollars on the monthly scale. And the reason that I'm still hesitant about a big push upwards is this area here that I've spoken about multiple times. So we can see here that we've got pretty strong resistance here at the $1,800 level. And as I've said before, I doubt that the price will break above that on the first attempt. I think it will take more than one attempt to do so. The only caveat to that is if we were to have some big announcement or geopolitical event, then that would slice through there. But because of all this complicated price action here going backwards and forwards, that's what's going to cause a little bit of tangling in this region here. However, having said that, I think we also do have strong support at around the 1520 level, both dating back from the kind of 2012 years, but also even more recently in late 2019. So I think that price is likely to remain consolidating below the 1800 level for a little while now. Moving on to silver in US dollars on the daily scale, silver's been doing very well. And last week we spoke about this area here, which was squeezing price, and silver broke out of that area. So now what I'm looking at is this upward sloping channel. And if that's the case, then continued upward movements would see price go into the $17 areas. The only thing I would say is that we do have a lot of resistance here at around the 1750 level, and this goes even further back if you look at silver on the monthly scale. So just watch out overhead, that is likely to present an issue there. And finally moving on to the gold miners. And so this is the GDX on the daily scale. And originally we had talked about this ascending wedge pattern again, and again we thought it had broken down just before May and then had gone up to retest the lower trend line. But having said that, we did also have a significant breakout from this horizontal line just below 32. But remember, I was hesitant about that because we were having very low volumes and these candles haven't looked particularly strong. Normally I like to see a nice big strong green candle for such breakouts, particularly one that's so significant. However, price has continued to move up, and I have to say that has surprised me a little. One of our viewers actually suggested that instead of this ascending wedge, this could be a channel, and that's certainly the case. So the way I've drawn this is that I've joined some of the highs at the top here and then cloned that line and moved it down to some of the lows, and it does seem to fit with that channel idea. In which case we don't know which direction the breakout is going to continue. If we move upwards, then we're looking at a move towards the 39 level. However, a break below the 35 level would suggest further downwards move. Now, remember here we've got another gap that's formed here, and then we've also got some unfilled gaps previously, and that always makes me a little bit nervous. And for me, although this could well move up, I'm not going to be moving in at this stage for a couple of reasons. One is that I don't like to FOMO into price. and those gaps make me nervous. But the other thing that does make me nervous is the stock market. Me personally, I'm bearish on the general stock market still, and whenever the stock market crashes, so do the miners. So that's my reasoning. And the other thing is that I don't really like to trade short-term moves. I'm really looking for good value buy points for longer-term holds, rather than short day trades or weekly kind of trades. So that's it from me. One of the things that I have found since doing these videos is that the viewer comments have actually stimulated some thoughts and ideas about future shows and things to talk about. And so if you do have any particular questions, particularly relating to precious metals related topics, then do let us know in the comments. I'll certainly talk about some of the thought-provoking ideas. So thanks for listening, and don't forget to like and subscribe, and we'll see you next week. Bye.